Welcome yet again to another episode on financial wellness. As usual, this is your coach, CPA Tonie Njiru, and today we shall be building a further discussing on investments, basically making a broad introduction into investment so that we can work together, starting to know what are the broad-based types of investments, and then how will we be able to invest? Where do we get the funds so that we can save, and how do we come up with the money so that we are able to invest? So right into the business, as usual, like our channel, click on that bell. If you have any comments, kindly share with us. We would love to know what you think about the content and how we can better improve our lives together. So first, when you talk of investments, we are looking at where you place your money so that you can generate returns. And investment, as we say, mentioned in our last episode, whenever you save, your savings should be generating returns so that you can grow financially. As you are aware, over time, money loses value due to inflation, which is general changes in price levels. So if you just save your money without generating any returns, then you're losing out. Your money is being worn down and it's losing value as the years progress by, as the time progresses by. So right into investments, broadly, we have two types of investments. First, we have what we call passive investments. And second, we have what we call active investments. So broadly, all investments in this world can be categorized only into two. That is passive investments and active investments. Now, passive investments are investments that generate income without you being involved. So put in a lay approach is where your money works for you. So in passive investments, you just need to place in your money and you'll be getting returns either by annually, monthly, and so on. So examples of passive investments will include investment in money market funds, which basically we do for emergencies. We have investment in SACCO share capital, investment in SACCO deposits, and SACCO is savings and credit cooperatives in full, investment in government bonds, investment in treasury bills by the government, investment in fixed deposit accounts with banks, investment in speculative land, where you buy land and you wait for the value to go up. You could also have investment in other passive investments like unit trusts. You could do unit trust. And finally, you have investment in rental properties, especially the residential rental properties. So those would be passive in nature. The other way is where you have a mature business that is already generating income, where you don't need to be involved in the running of this business, like what happens when you invest in shares in the stock market, where you have mature companies. So you're not running these investments. So those are passive investments. And later on, we shall do a video in which we shall be discussing these investments, specifically each and every of the investments and what role they can play in your investment portfolio. However, for now, we want you to get a broad perspective of the investments, and those are passive investments. And passive investments by nature have two key characteristics that distinguish them mainly from the active investment in terms of the mindset of an investor. First, passive investments are not visible. If you have stocks, if you have government bonds, it's not possible for people to know unless you tell them. Secondly, they appear to have low returns. Most passive investments will generate returns. If you're in Kenya, the returns would range up to maybe 20%, right from 8% as low as even 5%. So many investors feel that those returns appear low. And I'm insisting the word is appearance. Often than not the reality if you look at other factors that we shall be considering. Now, the other type of investment is active investments. And active investments are the investments where you're involved. You have to wake up, you have to run the business, you have to manage this business so that it picks up. So active investments will entail entrepreneurial skills. You have to manage the investment yourself. You have to be involved in the day-to-day running if it's a business. If you're in farming, like I said, I do avocados, hash avocados. Then I have to monitor my land. I have to make sure that my workers have done as expected. I have to make sure that the markets have been sourced right, and we have make sure that everything is running well. So those are active investments. You have to be actively involved. You have to participate in these investments. Now the question is, which one should we start with? Where do we invest first? Is it active? Is it passive, or a mixture of both? So in investments, generally investments are cyclical in nature. Most of us, we start making our money actively, which means we are either employed, you have to actively go and work, or we have an active business that we are running. And so our next investment then should be geared to passive investment. So we move from active to passive. We build a passive platform, and then from the passive platform, we can then move now to more active businesses. The mistake that many of us make is we want to rush to so many active investments. So you're already employed, and quickly you want to get into onion farming or apple farming or uh, 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 a transport business, and with that you find yourself getting you lose track, or you have burdened with the duties that you have to do. And in the event one of these active investments does not work out as expected, then you find this person is left in a lot of debt and a lot of problems. So investment is cyclical. Most of us, we start actively. We must then build a passive platform. Once we are comfortable with the passive platform, then we can now invest again actively, move into diversification. Now, in terms of how you're able to invest in a passive platform, investment is a function of or getting the savings so that you can invest will be as a result of a discipline. There is an author who has written a book known as The Psychology of Money. The author is called Morgan Housel, and in the book, he says that our financial freedom will depend on nothing but financial discipline. So we need a lot of discipline, and our discipline is a function of two things. One is our habits. We need to cultivate the right habits. In our last episode, we mentioned that you need to pay yourself first. Every time you make money, you start by saving before you can spend. So you start by paying yourself first before you can move into spending. So you need to cultivate such habits as saving. You need to cultivate such habits as budgeting, and we shall be discussing budgeting in a future episode. You need to cultivate such habits as tracking, so that you're able to track where you apply your funds. You need to cultivate habits such as investing. So the habits will determine your financial success. Secondly, are the rules of personal finance, because there are certain rules that you need to follow for you to ensure that you succeed financially. And we shall quickly go through these rules of personal finance. I would like our viewers and our followers to add any other rule in the comments that you feel maybe we have left out or we have not emphasized on, which can enhance our financial wellness journey. So the first rule is have a savings plan. Without a savings plan, you will not achieve the goals that you like to achieve. So you need to have a plan. And in our last episode, we mentioned you need to have a written down plan, a documented plan. Because if the plan is not documented, then you are likely to procrastinate. So you need to have this plan documented so that you're able to evaluate yourself as you progress with the plan. The second rule, thou shalt not spend more than you make. Thou shalt not spend more than you make. So you need to live within your means. If you're making 70,000 shillings maybe in a month, I will not expect you to be living in a house of 40,000 shillings, because then it would mean you're consuming more than half of your resource of your earnings to pay for your accommodation. So thou shalt not spend more than you make. And for us Kenyans especially, thou shalt not spend money you have not received, because we have the temptation to anticipate incomes, to anticipate inflows, and then we end up being in debt. You spend and you have not yet received this money. The next rule, thou shalt not keep up with the herd syndrome. Peer moves, that is competition. We are living in a world where people have a lot of social media influence. There is a lot of glam that is being shown in the social media, and people might be under a lot of pressure to spend so that you can live like your friend. So you find your friend has a 70-inch TV, and probably your TV is a 21-inch. So you feel you're under a lot of pressure so that you can get that bigger TV. And probably the quality of whatever you're watching may not be so much different. The results that the communication that you may be getting from this gadget, if you're watching news, the news content remain the same. So there is no marginal increase benefit for you to get yourself into debt so that you can compete with your friends. If it's your phone, it's not a must that you have the latest gadget. If you cannot afford is or is not within your current time frame. So at times we can have what we call delayed gratification. You don't need to compete with your friends negatively, because that is what that peer pressure may lead you to. The next rule is limit your short-term loans. The short-term loans, the loans that we get on mobile phones, the loans that we get on short-term basis, the interest rates often are very high. Bank overdrafts, credit card loans, those loans are purely meant for emergencies. And in life, there are three emergencies that you may encounter: either sickness or accidents, natural calamities, or matters that may disrupt you in terms of the law, instances in which you have to interact with the law. Then those are real emergencies. So we should not take those short-term loans where there are no real emergencies. And we shall be discussing emergency planning in our future episodes, what you need to do to plan for emergencies, because emergencies is something you plan for. You do not anticipate the emergency, but you can plan yourself so that should it ever happen, then you're well prepared. The next rule is pay your monthly bills in time. Anytime you have resources, it is good that you make sure that those routine bills are paid, so that in the event you're in financial distress, then your suppliers will be in a position to understand that this person usually pays. It's not an instance where you're just being tough-headed, as you may assume you always are, if you're not paying your bills in time. So it's always good to pay your bills in time. Avoid get rich quick schemes is the next rule. Avoid get rich quick schemes. And the variety of get rich quick schemes out there in the market are so many that so many people are falling into them. They will range from betting or gambling, and the unfortunate bit, it is the poor who gamble the most. So they range from gambling, they will range to multi-level marketing. We will have people selling online forex, people selling what we call clickbait on internet, where you have to click so that you can make money, but you have to make some premium payment upfront. People selling online courses that may promise you fitness, they will promise you wealth, and so on and so forth. So we need to check ourselves from these get rich quick schemes, because often than not, it is your money that is being targeted rather than making you rich. The next rule is you need to prioritize your spending. The resources we have are scarce and limited. However wealthy you may be, if you do not regulate your expenditure, then you can easily lose your wealth. So you need first to create an investment where the wealth is being replenished, and then you need to watch out on your expenditure by having a priority. Anytime you receive resources, you need to prioritize that, and we have tools to assist you, such as expense trackers, such as budgets, which we shall be speaking on to in our future episodes. The next rule is that you need to eliminate potentially damaging spending behaviors. So you need to carry out an introspection of who you are and what are the behaviors that are injuring your money or your wealth plan. Because everybody has some habits or behaviors that may be watering down their likelihood of success in terms of funding. Examples would include things like working with liquid cash. There are people who will work with liquid cash. Every time you're paid, you withdraw money from your ATM, and you want to have it in your pocket. And after a few days, you find that this money is all gone. I liken working with liquid cash as trying to rear a food animal, maybe like a chicken, as a pet. Instead of rearing a dog or a cat, you're likely to find that you have consumed that chicken. So you need to be purposeful in terms of identifying those habits that are wearing down your money. And there are a variety of habits that may wear down your money. Some people use overconsumption of alcohol, they're into addictions. Some people, it is having many lovers that are consuming your money. Some people will move into impulse buying. You get into the supermarket and you buy without any plan. So each and every person is capable of doing a self-introspection and identifying the ways in which they lose their wealth. The next financial rule, or the rule on personal finance, is managing risk. You need to protect yourself against risk. And when you talk of risk, we are looking at any event that may materially disrupt your financial journey, that may distort this plan and may imply that your plan could be even terminated altogether. So the only way to protect yourself against risk is, one, by creating an emergency fund. Secondly, is by investing broadly, so that if one industry is affected, then you're likely to be covered in a separate industry. The next rule is that you need to teach your children about lessons on finance, because your children will inherit and they also will influence how you spend your money. So you need to take your time to make sure that your children are exposed to lessons on finance, depending on their age appropriate lessons. You don't need to spoil them with money, but it's good that they are aware that money is a scarce resource, and money is not the end, it's just a means to a quality life. You need to plan for your retirement early, is our next rule. Plan for your retirement early. One day, there will be a point in time where your energy in terms of work, and there will also be a point in time where you will not be able to be actively involved in employment as you currently probably are. So you need to plan for that day, and you need to plan for your retirement away from your employer if you're employed. Ask yourself, what if your employer is not in a position to cover your retirement needs? How do you retire? How shall you provide for yourself in retirement? And as you plan for your retirement, it's important for you to be aware that the pinnacle of your consumption of your wealth will come before your retirement. So there are people who work their entire life just to construct your retirement home. That is not a quality life. So you need to make sure that as you're moving towards your retirement and you have in your plan, there is also an allowance for you to be able to consume or to live a quality life. So a quality life is a balanced life, not an extravagant life, and not a pauper's life. And the last of our rule is you need to protect yourself legally in instances that you're entering into contract. In acquisition of investments, invest where your money is legally protected. You're buying land, for instance, you need to make sure that you follow the right procedures. You have a lawyer, you have done your proper due diligence, you've paid someone for the land, they should move out of the land so that you possess the land. You have the documentation. You have written a will, for instance, how you'd want your assets to be distributed upon your demise. You have indicated who is likely to inherit your properties. That way, you are legally covered. You enter into a business with someone, kindly come up with an agreement. Each of you signs the agreement, have your own copy, so that you protect your wealth from being lost to people who may be out to defraud you. So those are the rules of personal finance, and that brings us to the end of this episode on the investments. Our discussion was a broad introduction to investments. It's important to note that we have not gone specific to which type of investments that you should be making. We have broadly categorized the investments into passive and active investments. We have said there is a need for you to build a passive platform before you can then venture into another active investments. We have looked at the need for discipline for you to be able to achieve that. In our future episodes, we shall be looking at the investments, the specific investments. In our future episodes, we shall also be discussing how you accumulate resources in a passive investments despite the characteristics that we mentioned. Thank you very much for listening to us. Kindly hit the subscribe button, like this video, share with your friends, and follow us on our various platforms. We are on social media. My name is CPA Tonie Njiru. I'm on Facebook as Tonie Njiru, Instagram as Tonie Njiru, TikTok at Tonie Njiru. Thank you very much for your time.